Disruptive innovation, which is volatile, is going to be a good hedge against some of the value traps that are in traditional portfolios, because many companies are going to be disrupted by truly disruptive innovation. We consider our portfolios to be an important hedge, and we think most asset allocators out there are short truly disruptive innovation.
In this recent interview on the Morningstar Europe with Cathie Wood, we learn about the dramatic cost declines in artificial intelligence that are reshaping investment strategies, the evolving electric vehicle and autonomous mobility landscape amid global macro headwinds, and the bold strategic shift toward active ETF management driving disruptive innovation. Cathie Wood explains how these powerful trends are not only redefining technology, but also creating enormous opportunities for investors willing to look beyond today's market noise. Before we begin this discussion, don't forget to like, subscribe, and share this channel. Now let's hear more from Cathie Wood.
We looked at DeepSeek's model and learned that it is moving down the cost curve associated with this new technology at a rapid rate, but not much different from the rate at which OpenAI and Anthropic are riding down the cost curve. So inference models, the cost to develop them, they're dropping 85 to 95% per year. Now, the big question with DeepSeek is $6 million, really? Is that all it costs to develop that model, compared to 10 times that or more from OpenAI and Anthropic? There's a big question mark there because we don't know how much pre-training there was done before developing that model on a high-end workstation. So the drama was really around, wait a minute, is it going to cost much less because AI model development is moving to the edge, to high-end workstations instead of cloud providers? That's where the question marks are. And we don't have all the answers. But in terms of the cost declines that we're seeing, both on training and inference, DeepSeek is just following that pattern. Well, we know it all started with hardware, NVIDIA, TSM, and we're still involved with those in a number of our funds. But we have been evolving our portfolios in terms of weightings towards software and what we call embodied AI. Software more platform as a service, like Palantir. Embodied AI would be Tesla moving towards autonomous mobility, which could not happen without artificial intelligence. And also, importantly, we've been focused on the multiomics or genomic space, where the convergence between sequencing technologies, artificial intelligence, and CRISPR gene editing, though that convergence is beginning to cure diseases. So we think while the biggest opportunity in the next 5 to 10 years from a revenue generation point of view might be autonomous mobility, the most profound applications, we think, could be in the healthcare space as we move towards curing disease and increasing human longevity. Well, it's interesting. Last year, the political risks were all around, in the U.S. at least, Republicans not being interested in electric vehicles. They wanted to support the energy industry and gas-powered cars. This year, it seems that now that Musk is in charge of DOGE, the Department of Government Efficiency, that the Democrats are not happy with that, but the Republicans are. So I think there are puts and takes here. I think one of the other confusing factors is Tesla has the largest selling car in the world, the best-selling car, the Model Y. The Model Y is now going through a major refresh cycle, much like the Model 3 did last year. And so people like me, I was going to buy a Model Y in December, and the Tesla showroom people said, no, wait, because the Model Y refresh is going to be quite significant. So I waited. So that's another bit of confusion out there. There's no doubt that some people will stay away from electric vehicles in the short term, perhaps for political reasons. But as the costs associated with electric vehicles continue to come down and drop well below the gas-powered vehicle prices, we think economics will win the day.
As we just heard Cathie Wood discuss the game-changing cost declines in AI and how they are transforming investment strategies, now let's hear her elaborate on the seismic shifts in the electric vehicle and autonomous mobility sectors and explain how active ETF management is evolving to capture disruptive innovation. Her insights on these interrelated trends provide a unique perspective that challenges conventional thinking in the world of finance. Now, let's listen to what Cathie Wood has to say.
Well, electric vehicles are facing macro headwinds, just like internal combustion engine vehicles. So if you look globally last year, I believe electric vehicle sales were up 12%, while internal combustion engine related sales were down by 1%. And if you look at the gas-powered vehicle sector, as recently as 2019, gas-powered vehicle sales globally accounted for 92% of all sales. Today, they account for only 72% of sales. So we do think the shift towards electric and a bit of a jog towards hybrid, certainly here in the US, but I think that was true around the world, might be distorting the pure battery electric vehicle space. But we do think as costs associated with electric vehicles continue to fall, and we think they will, Tesla is rumored to debut a car for somewhere in the $25,000 range this year, and robo-taxis, we think, could drop to a cost of roughly $15,000 in the next couple of years. So we think the move towards electric is still in place, might have slowed down a little bit, but we think there's no stopping it. Well, in terms of Bitcoin specifically, we characterize it as three revolutions in one, and they're all global. So the U.S. might want to encourage innovation around crypto asset or digital asset activity. But we do think that Bitcoin is a global monetary system. It's a new global asset class. It's the first of its kind in a new asset class. And it is a technology, a global technology. So no one country is going to have a lock on it. Perhaps with the right incentives, there will be innovation around Bitcoin and other digital assets. And we do think this administration here in the United States is very interested in cultivating this movement here in the United States, much like the internet. The internet, in fact, this is just the next generation internet. This is the part of the internet that developers did not build in the early 90s because they never knew that financial services and commerce would take place on the internet. So this is the next generation internet. And just like the first generation, it is global. There are many companies benefiting from it. I do think some of the major ones, certainly the Mag 6 here in the United States, have been some of the biggest beneficiaries. And I do think this administration wants to make sure that government policy, in other words, does not get in the way of innovation.
To watch the full interview, check out the link in the description. Cathie Wood shows us that the rapid reduction in AI development costs is setting the stage for transformative technological change, that electric vehicles and autonomous mobility are confronting and eventually overcoming macroeconomic headwinds. We would love to hear your thoughts on some questions. How can investors best capitalize on AI-driven innovations while managing risk in volatile markets? Will the evolution of autonomous mobility redefine the future of transportation investments? Thank you for tuning into Only the Savvy. If you enjoyed this discussion, please subscribe, like, and share our video for more engaging content exploring the innovative world of decentralized technologies. Thanks for watching. Help support this channel and receive exclusive offers from one of our partners located in the description. We'll see you on the next one.